Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to continue the series of discussion how to determine whether the stock is still a good buy. This video, I will concentrate on price to book P over B ratio to determine. For this example, I will use a Singapore bank. So this video, I will use this price to book to determine this Singapore bank DBS whether it is still a good buy or not. But nevertheless, you can always apply this technique to other stocks. So in short, this is actually a step-by-step stock analysis using another parameter, which is price to book ratio. Before I continue, guys, I'd like to urge you guys to help me by like this video. Guys, just give me a few seconds. Help me press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer, this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you're willing to lose. With this, we are ready to kickstart today's discussion. There are various ways to determine whether this stock is still a good buy. Early on, I have covered all these three to determine whether this stock is still a good buy. For example, the most fundamental that we often use will be the price to earning ratio. Next will be price to earning growth ratio. Basically, this with potential growth of the company or looking back at the history of the growth of the company. This will give a better parameters as compared to the PE. If let's say, you're going to do a comparison between these two quite similar company. Next, we have this price to free cash flow. The reason why we want to use this parameter is we want to eliminate manipulation as much as possible because cash is much more difficult to manipulate. This video is also worried about people manipulate the numbers. So therefore, we have this price to book ratio, which is mainly to asset. So again, asset, it is harder for us to manipulate. This is typically used for a company that has a big asset. For example, like banks. For example, for banks, the loan is actually asset. So later on, I will have this example using Singapore Bank, DBS, to use this parameter, price to book ratio to determine whether it is still a good buy. Besides valuation, we have other parameters. For example, we can look at the financial health of the company. We can also looking at the stability of company to determine whether the stock is still a good buy. Besides financial health and stability, again, profitability is the most important one. Any company with good profitability, definitely the stock will be a good buy. So again, we will look hard on all these parameters at profitability in order to determine whether the stock is still a good buy. Last but not least is in terms of the growth aspect. So basically, if let's say you invest into growth stock, we definitely need to look at the potential. What will be the growth potential? Maybe in forward looking at 5 years, for example. So basically, all these parameters, we will discuss them one by one. But like I mentioned earlier on, this video, I will concentrate on price to book ratio. Let's come to today's topic, which is price to book ratio. What is actually price to book ratio? So this in fact is a fundamental financial metric that is used primarily to determine a company values by comparing its current market value, which is the current share price, to its accounting book value. So later on, I will further explain. In fact, you can see from this equation, this is actually for price to book ratio. You can see that it's actually equals to the current share price of the company over the book value per share. So basically, this is the formula to compute the price to book ratio. I will do a little bit more explanation. So like I mentioned earlier on, your market price per share is actually your current stock price. Let's come to the book value per share. So over here, you can see that the book value is actually equals to the total asset, which means that all the asset that is actually owned by the company minus away the liability. Okay, for example, okay, let's say the company take a loan that is considered a liability. Let's say the company order a stock, so basically it owns suppliers some money, and again, these are considered liability. Let's say the employee salary is also considered liability. So therefore, we can take whatever asset that we actually has, minus away all the liability. This will be equal to the book value. And then let's say we divide by the numbers of outstanding share. This will be the book value per share. This is what I mentioned early on. The book value is actually essentially the shareholders' equity as report on the company's balance sheet. It actually represents what will be left for shareholders if the company were liquidated at its balance sheet values. Okay, so this is actually for the price to book ratio. In general, okay, how can we actually interpret this price to book ratio? Okay, first case will be the price to book ratio, which is more than 1, which is the most common, which is desired. Next will be price to book ratio equals to 1 exactly. And then last but not least, price to book ratio less than 1. Let's start on this price to book ratio more than 1. In fact, this is the most common one. Why? The market value the company at more than its book value. Let's take a look on the equation to understand this. This is what I told you. This is actually your stock price over, okay, whatever the book value. Keep this in mind. The stock price is forward looking. Okay, so which means that if the stock, okay, is higher than the book value, this means that people actually prefer this stock. Okay, so basically, like I mentioned earlier on, the stock price is actually forward looking, which means that potential the company will have a better growth. So therefore, the stock price is actually higher than the book value. So in short, we want the P over the B ratio to be as big as possible. So this is what I have explained. Okay, so this is what we want. This is the most common. Okay, so what happened here is basically the market value, okay, which is the stock price. Okay, they are more than its book value. This is ideal. So this is typical, and this simply means that the market believe the company future earning power, the brand, patent, or intangible asset, okay, they are not fully captured on the balance sheet. They are all very valuables. For example, let's say a tech company. Okay, so they actually have a strong brand. For example, let's say Apple. Definitely, Apple actually has a very strong brand, and they also have software. They may have a very high so-called price to book ratio because it key asset. Okay, for example, IP, human capital, they cannot fully reflected on the balance sheet. Okay, so therefore, for price to book ratio, we want it to be as big as possible. Next, okay, what is actually price to book ratio is equals to 1, which means that your stock price or the market value is exactly equals to the book value. Okay, so which means that everything is exactly. Okay, so basically they match. Coming to the undesired, price to book ratio less than 1. Okay, this means that the market value the company is actually less than its book value. Okay, so this could signal that the company is undervalued or more pessimistic that it has serious problem. Okay, its assets are overvalued on the books or is not generating an acceptable returns on its asset. Okay, so basically, this is how we interpret the price to book ratio. There are actually 3 of them. Next, the use case of price to book ratio. When we can actually apply this price to book ratio. In fact, this is mainly for asset heavy company. Okay, so it is most reliable and commonly used for industry with large tangible asset on their balance sheet. Okay, for example, the bank and the financial institution. Why? Because the loan is actually considered as asset. They have huge asset. So therefore, this price to book ratio will be a very good indicator to determine whether this stock is still a good buy or not. Next will be manufacturing companies. Again, imagine this. For manufacturing company, you have lots of raw materials and you have a lot of finished product. These are classified as asset also. Next will be insurance company, real estates like REITs. Okay, so this price to book ratio will be less useful, for example, for service or tech company. Why? Okay, because this rely, okay, which means that the tech company, for example, they rely very heavily on intangible asset. For example, their IP, their brand, their software, which are often expressed, okay, basically they are not able to capitalize as asset, and thus they don't appear fully on the balance sheet. This led to a very high or meaningless PE ratio. Basically, the company with consistent loss, negative book value that make the ratio unusable. So basically, these are for less useful, okay, for service or tech company. Next, let's come to the strength and the weakness when we actually apply this price to book ratio to determine whether the stock is still a good buy or not. Let's come to the strength first. Firstly, it is actually very simple and the objective is also clear. The book value, in fact, will be a very clear number from the balance sheet. Okay, so therefore, we are going to have lesser prone to people that actually manipulate as compared, like for example, earning can be easily manipulated. Useful for comparison. So they are actually good for comparing firms within the same asset-intensive industry. For example, let's say okay, in Singapore, there are actually three banks, DBS, OCBC, and UOB. Okay, so basically they are all asset-heavy. So I can use this price-to-book ratio to determine which is actually a better buy. Okay, again, later on, I will do a comparison out of these three Singapore banks. Next, indicator of value. Okay, a low price to book ratio can be a starting point for finding potential undervalued stocks. Coming to the weakness, okay, so they actually ignore okay, intangible asset. For example, as I mentioned early on, for those tech company, okay, they have IP, they have all software, they are all unable to account. Okay, basically this method they are unable to fully account the value of brands, patents, human capitals, and also the competitiveness advantage. Next will be the accounting limitation. Okay, book value is based on historical cost accounting, not current market values. Okay, a factory that is purchased 20 years is on the book at its old price, not at its current real estate value. Next, okay, so this method may not be useful for asset light. As I told you that this price to book ratio is good for asset heavy, definitely not for asset light firm. Okay, as mentioned earlier on. Okay, so basically this is in fact ineffective for many modern company. Like for example, you have the Uber, but Uber don't own the taxi. So basically, this is not going to be useful to analyze, okay, for people like tech whether this stock is still a good buy or not. Okay, so this can be misleading. For example, a low price to book ratio, they might not be a bargain. Let's say if the company is in decline and is also asset like inventory, all the old equipment, they are all overvalued or obsolete. But over here, you can see that this is also another indicator. We have do all the rest of the indicator, for example, price to earning. This can be another indicator to determine for heavy asset to determine whether this stock is still a good buy or not. Let me share a very simple practical example. How can we actually compute the price to book ratio? For example, this company XYZ, okay, they have a stock price of $50 per share. The total asset of company XYZ will be 10B. Okay, the total liability will be 7B. Okay, so the total number of share or shares outstanding will be 100 million. Okay, so step number one, how can we actually compute the book value? If you still remember, okay, so it will be so-called same as shareholder equity. So it will be the total asset minus the total liability. So over here is quite clear. The total asset will be 10B and the total liability will be 7B. So from here we can see that this book value is actually 3B. Next, we need to calculate the book value per share. So we know that the total share will be 100 million. So therefore 3B divided by 100 million, this will give us book value per share of $30. With all this, we are ready to compute the price to book ratio. Okay, so again, how we can compute this? This will be the current share price, which is $50 per share, divided by the book value per share. So from here, we can compute that the price to book ratio will be equals to 1.67. how can we interpret so-called this number 1.67? Okay, so this actually indicate that the market is willingly to pay 1.67 for every dollar of XYZ book value. Therefore, with this, we can also conclude that investors strongly believe the company future prospect or intangible asset make it worth more than its net asset alone. Okay, because you can see that the price to book ratio is more than 1. Let's come to the bottom line of price to book ratio. Firstly, let's quickly revisit what is actually price to book ratio. In fact, this price to book ratio is a snapshot of how the market actually values a company relative to its balance sheet of net worth. Is a valuable tool, particularly for value investing and analyzing financial or industry firm. But we need to keep this in mind. This price to book ratio should never be used in isolation, which means that we cannot depend just on price to book ratio. Just use this to determine whether this stock is still a good buy or not. We should always combine with other metrics like price to earning ratio, debt to equality, and some qualitative analysis in order to get a complete picture of a company value. Guys, before I continue, okay, for example, later on, I will give you an example how to use price to book ratio to determine this Singapore bank DBS is still a good buy or not. But before I continue, I like to urge you guys to help me by like this video. Guys, just give me a few seconds. Help me press the like button now. When more guys actually help me to like this video, okay, so this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. Next, let's use a practical example. Okay, so let's use this price to book ratio to determine whether this stock, which is a Singapore bank, DBS, is still a good buy or not. Firstly, where to look at the number of price to book ratio. For example, at this link, you should be able to find out what is the price to book ratio for DBS. Okay, so it is around 2.4 currently. Okay, so you can also see the history of price to book ratio for DBS. Okay, so therefore from here you can see that from year 2008 all the way until 2025, you can see the history of price to book ratio. So actually we can conclude that this price to book ratio is around 2.4. So what can we actually conclude? Okay, so from this number we conclude that investors are willing to pay about 2.4 in market price for every $1 of book value the bank has on its balance sheet. Historical data actually suggests that DBS price to book ratio has rise from 1.4, okay, which is some years ago, to around 2.3 to 2.4 now, indicate that the value expansion over time. Okay, so this is what I mean. Some years ago, okay, so let's say some years ago, around 2024, okay, you can see that the price to book ratio actually increased. So this is what it means. So basically it shows that consistently DBS has rise from the 1.4 some years ago all the way now, which is around 2.3 to 2.4 now. Okay, so basically this actually indicates that this bank DBS is still a very attractive stock to buy. Let's go a little bit detail. Okay, what price to book ratio 2.4 actually tell us? Firstly, it's actually value versus the book net asset. We know that if the price to book ratio is more than 1, this is actually desired. This is because the stock is actually trading above its accounting net asset worth. Means the market actually expect future earning, return on equity, or strong intangible value. So when we actually compare with DBS historical range, okay, so 2.4 definitely is above its long-term average. However, so with this, you actually conclude that the stock is actually not cheap, okay, by its own history. But this is actually not considered very, very high. So for price to book ratio to be around 2.4 like this, okay, it is actually typical for banks. Banks typically they will trade at a higher price to book ratio, okay, when the return on equity is strong, profitability and also dividends are solid, capital ratio are healthy. For example, in Singapore, majority of the bank are actually above one. Okay, so as it described over here. Next, on the other valuation and performance signal. So let's take a look on the earning and dividends outlook. DBS show reasonable earning and dividend stability with forward price to earning ratio in mid-teens, which means that they are actually quite positive. Analysts actually sometimes peg the share price target moderately above the current price, although this isn't guaranteed. So let's say we compare DBS with smaller price to book ratio. Okay, so for example, if another bank okay having a lower price to book ratio, let's say 1.4, okay, so this may seem cheaper, okay, but cheaper does not always means better. The bank might have weaker growth aspect or lower profitability. Next, how can we actually use this price to book ratio in a buy decision? So when it might be a good entry. So for example, if you believe that DBS will grow book value over time, okay, for example, they can return their earning, the asset quality actually improve. So another reason is if the banking sector outlook improve, okay, so this will actually make DBS a very good buy. So when valuation look expensive, okay, for example, a high price to book ratio as compared to history, it actually suggests a lot of optimistics is already priced in. So if the interest rate fall, okay, because bank profit is largely depend on the interest rate. Let's say the interest rate fall or bank earnings low, okay, the stock could trade closer to book value again, which means that they will be closer to one, the price to book ratio. Thus, okay, with price to book ratio alone, okay, so this cannot just tell you that whether DBS is a good buy. So in fact, it tells you that the market value, the bank at a premium to its balance sheet. So you need to combine, okay, with growth aspect, dividend yield, and broader economics outlook. Coming to my last slide, let me do a quick summarize for DBS. So this is what we have discussed extensively. Okay, so the practical takeaway, so the price to book value 2.4, this actually indicate that DBS is not a deep value stock. Okay, the market is pricing in growth and profitability. Okay, so which means that, for example, DBS, we have value stock and growth stock. So this is not really, okay, under this value stock. So basically, because there is some form of growth and also some form of profitability, so therefore DBS cannot just purely say that it's a value stock. It might be still a good investment. Okay, so if you believe in DBS ability to grow earnings, maintain dividends, and manage its risk well. So if you want value bargains, you might prefer banks that is actually trading at lower price to book ratio, okay, but they may come with weaker fundamental. Okay, so with this, I like to end my discussion. However, my next video, I will do a quick comparison on this price to book value ratio for DBS, OCBC, and UOB so that you can have a better understanding on this. With this, that's all I have for you guys for today. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.